In this video, I'm going to walk through the differences in calculating unit product costs and preparing income statements for absorption versus variable costing. Now, when we talk about product costing, I'm going to start with that first. We're talking about manufacturing costs, and if you recall from past chapters, that's direct materials, direct labor, and manufacturing overhead. And we have our overhead broken down by cost behavior, both variable $3 per unit and fixed is listed in total at $300,000 for the year, fixed manufacturing overhead. Ultimately, they want us to calculate the unit product costs, so let's get our fixed overhead also on a per unit basis, since our variable overhead is that way, and direct materials and direct labor are also stated on a per unit basis. And we're going to divide that $300,000 in fixed manufacturing overhead by the number of units produced, 25,000, and we get $12 in fixed manufacturing overhead an average per unit. I will note that I use the number of units produced, 25,000, not the number of units sold, 20,000, because keep in mind that 300,000 went into the 25,000 units produced, irrespective of whether they're still on hand or they're sold. So that's one important thing. We didn't know it to this point prior chapters, but everything we've covered about product cost was absorption costing. The inventory absorbs any manufacturing costs, direct materials of $6, direct labor of $9, and both variable overhead of $3 and fixed overhead of $12 for $30 total. Again, we probably didn't know the term before this chapter, but we had covered absorption costing. What's new in this chapter is an alternative to absorption costing that only includes the variable elements of product costs. So it has in common with absorption costing direct materials of $6, direct labors of $9, and variable manufacturing overhead of $3, but it stops there and totals up to $18. It excludes, the only thing that's different is variable costing excludes fixed manufacturing overhead. Now, I will note a lot of times there's confusion because of the name variable costing. A lot of times individuals will think, well, why didn't you add the variable selling administrative? I also need to add that $4 on and bump it up from 18 to 22. No, keep in mind, selling administrative is not a product or manufacturing cost. If you recall from our earlier chapter, it's a period or non-manufacturing cost, and we're trying to calculate unit product cost. So now we have our differences in unit costs, absorption 30, variable costing 18. Also, the way that we prepare the income statement is going to be different. And I have a basic summary here. We even can go back to financial accounting, that typical multi-step income statement. We've also prepared one earlier in the semester. We start with sales, subtract all of our product costs. I don't care whether they're variable or fixed, all of our product or manufacturing costs, and we get what's called gross margin or gross profit. Again, we can even go back to our financial accounting class, and that's what it looked like. Now, we also have to subtract out our selling administrative or period or non-manufacturing costs to get our net operating income. That was prepared according to absorption costing. Now, we've prepared a contribution format income statement in a past chapter, but what we might not have realized is that would be prepared using variable costing. So we're going to take sales minus any variable expenses. I don't care if they're product related or period related, it doesn't matter. We're going to subtract all our variable expenses. And when we do that, we get not gross margin, but contribution margin. Then we're going to subtract out any fixed expenses. Don't care if they're product period, manufacturer or not manufacturer. We're going to subtract them all out to get net operating income. So my starting point is going to be the traditional income statement using absorption costing that you're most familiar with. So let me prepare some room here. Where did I get the sales of $1 million? Well, if I read through the scenario, they tell us that we sold 20,000. Sales is going to be based upon the number of units sold, not the number of units produced. Sold 20,000 at $50 per unit, so that would be $1 million total. Cost of goods sold, again, it's going to include, doesn't matter if it's variable or fixed, all of our product costs using absorption costing. That's $30 per unit times 20,000 units sold. Again, it's important to use the number of units sold, is $600,000 in cost of goods sold. Subtract from that from the sales of $1 million, and we have what's either called gross margin or gross profit of $400,000. Now, to this point, we've only subtracted out our product or manufacturing related costs. We also have to subtract out our period or non-manufacturing selling administrative, and that's going to include both a variable and also fixed component. Variable selling administrative, $4 per unit times 20,000 units sold gives us variable selling administrative. To that, add our fixed selling administrative of $190,000, and we would get total selling administrative of $270,000. Subtract it from our gross margin, and our net operating income is $130,000. That's according to our traditional absorption costing income statement. An alternative that's new to us, though, is the contribution format using variable costing. Now, the starting point is going to be the same. The way we cost things isn't going to change our sales. It's still going to stay at $1 million. But recall, the difference in preparation is whereas traditional subtracts out all our product costs and separates out our period costs, with our contribution format, we're first going to subtract out variable costs and then subtract out fixed costs. So we're going to take our variable cost of goods sold, and recall, using variable costing, that's only $18 because we're only including the variable elements times 20,000 units sold. We also need to subtract out any other variable expenses, which also includes our variable selling expense at $4 per unit times 20,000 units sold. So total variable cost of goods sold is $360,000. Variable selling expense is $80,000. Add those together, and that's total variable expenses of $440,000. Subtract that from our sales, and we get a contribution margin of $560,000. So we're halfway there with this income statement. The last thing that we need to do is subtract out any fixed expenses, and we're going to do that in total. Our fixed manufacturing overhead, subtract out $300,000. Our fixed selling administrative, $190,000. So we add those two together, we have total fixed expenses of $490,000. Subtract that from our contribution margin of $560,000, and that gives us a different net operating income. So these aren't going to be the same. $130,000 was our absorption costing income statement, whereas our variable costing net operating income is going to be $70,000. So we do expect it to be different because we have treated fixed manufacturing overhead differently. Now, this is the important part of it for you as part of preparing your homework problems and also your exam. If you're still scratching your head and saying, I don't really get how they're different, I can also provide an explanation of that. Again, absorption costing net operating income is $130,000. Variable costing said $70,000. That's $60,000. I can explain where the $60,000 difference came from. Recall, the only thing that these two do different when they prepare their unit product costs is how they handle fixed manufacturing overhead. And recall, fixed manufacturing overhead was $12 per unit. Now, I'll also note we had a change in inventory. So if we didn't start with an inventory and we produced 25,000 units and we subtract out the 20,000 units sold, that means we must have increased our inventory and had 5,000 units in ending inventory. If we take those 5,000 units that we added to ending inventory and did not become part of cost of goods sold because they're still stuck in finished goods, times the $12 per unit, we get our $60,000. With our absorption costing traditional income statement, we took $60,000 that would have been expensed as part of the total fixed manufacturing overhead and variable costing, and I don't want to say this in a negative way, we buried it in inventory and finished goods and didn't yet expense it as part of absorption costing. So making a choice between absorption costing and variable costing does change our net operating income based upon whether or not you're building or lowering your inventory. Doesn't mean we make a choice of methods based upon what makes it look higher. Just want to explain it does create a change.